Welcome to De-Risk, a podcast where we provide a no-nonsense analysis of stocks. Today we're jumping into a deep dive on Lithium Americas, ticker LAC. We're distilling the key takeaways from our research captured this morning, October 1st, 2025.
Yeah.
Okay, let's quickly set the scene. The broader market is struggling a bit, running risk off this morning. Futures down about 0.5%. But look, this isn't really about the macro chop today. The real story here is this massive sector-specific tailwind. We're talking about the U.S. government's push, its commitment, really, to securing domestic supply chains for critical minerals. And that pivot, it's fundamentally altering how we value these kinds of domestic resource projects.
Yeah, it's fascinating. What's really shifted here is how LAC has moved beyond just, standard government funding. They've got structural validation now. Our research showed the U.S. Department of Energy, the DOE, isn't just handing out a loan. No, they're taking a 5% equity stake directly in LAC.
Directly in the company.
Right, and another 5% in the Thacker Pass joint venture itself. That's a crucial distinction. It basically transforms the government from just a lender into, a committed business partner.
Wow. Okay, that certainly sounds like a huge vote of confidence. I mean, fundamentally mitigating the financial risk you'd normally see with a pre-revenue mining operation, right? But, how much real-world risk does a 5% government stake actually mitigate when the market's still kind of skeptical about the long-term price of lithium? And this is all wrapped up in that restructured, $2.26 billion federal loan?
Exactly.
Of which they've already drawn like $435 million. That was secured with GM, I think.
That's the deal, and that's the critical question, really. This whole situation is basically a showdown. You've got this geopolitical game-changing catalyst on one side versus these, let's say, traditional valuation models and market skepticism on the other.
Exactly. And if you look at Wall Street, the consensus is overwhelmingly cautious, like 9 out of 14 analysts holding firm with a hold rating. And we've actually seen sentiment shift away from buy ratings recently. Their models put fair value around, $6.19?
Yeah, about that.
Which suggests, minimal upside from yesterday's close of $5.71.
Yeah.
Barely anything.
The options market, it's telling a completely different story. Traders are putting real money down and they're leaning aggressively bullish. The put-to-call ratio is sitting at 0.58. So for you, the listener, that means nearly 2 bullish calls are trading for every single bearish put. That's significant.
Okay.
They are betting heavily on this thing moving up, especially around that $5.50 call strike. Lots of volume there.
So this clash, this is what sets the stage for potentially massive volatility.
Absolutely. And then you look at the short side. Our research shows 11.57% of the float, the available shares, are sold short right now.
Wow, over 11%.
Yeah, and that short interest comes with this incredibly dangerous time constraint. The days to cover ratio, it's close to 5 days.
5 days, that's huge.
It is. It means if the price keeps ticking up, those short sellers, they can't just easily get out. They'd basically be forced buyers fueling the rally for nearly a week, just trying to close their positions.
Right.
Makes a squeeze scenario highly likely.
Okay, so the fundamental backing's strong, the options market is convicted.
Yeah.
What does the technical picture confirm in our research? Does it line up?
Oh, it lines up. The technical evidence is crystal clear, actually. The long-term trend has decisively flipped bullish. Our money flow indicators, they're showing what we call a stampede, just massive volume pouring into the stock, confirming the conviction behind this sharp breakout move.
All right, so considering the government validation, the technical breakout, our strategic outlook here is cautiously bullish, makes sense, but we have to acknowledge the immediate friction points.
Yeah, we do. Yeah, there are 3 immediate risks, really. First, just the drag from the weak broader market. Can't ignore that. Second, the stock already saw a pretty harsh rejection from its pre-market highs, back near $8.18. So there's resistance there.
Right.
And third, you've still got that persistent skepticism from the majority of Wall Street analysts that hasn't gone away.
Right. So for you, the listener, navigating this kind of volatility means focusing on some key battleground levels, the ceiling, like the level for the next sustained leg up. You need to see a break and hold above $8.20. Let's call it $8.20. The immediate floor, where buyers might step in, around $7.40.
Seems reasonable.
And crucially, the critical invalidation level. This is the price that basically launched this whole move. It's yesterday's close, $5.71. If it closes back below that level, then the technical breakout has likely failed.
That's the line in the sand.
Yeah.
The true deep dive question here maybe is, does this level of government investment officially signal that, critical mineral supply chain security has actually transcended pure market fundamentals? Is it fundamentally changing how we value domestic production going forward? Something to think about. That's all for this deep dive. Remember, this podcast is for informational purposes only and isn't financial advice. Do your own research or consult with qualified financial advisors before making any investments. Thanks for tuning in. Catch you in the next episode.